All right, we are calling to order at 11:03 the Center County Retirement Board meeting. We are seeing no one here for public comment. We will move then to our meeting minutes from April 15th. Is there a motion to approve those minutes?
So moved.
It's
Second.
it's been moved and seconded. Any final discussion on the minutes? Hearing and seeing none, all those in favor of approving the minutes do so by saying aye. Aye.
Aye.
Aye.
Motion is carried. Minutes are approved. We have no correspondence today. We have a little bit of a discussion on the presentations for the RFP for the dates and times for that retirement fund investment consultant. And what have we come up with so far, Jason? Anything to report?
I just wanted to update. I have been sending calendar invites, but I just wanted to make sure we had it on, that we had notice out there that on May 13th, from 1 to 4 p.m., we will be having presentations by the three finalists, PFM, Vanguard, and Marquette, and all of the times for them have been confirmed. So that will happen on that May 13th, Thursday afternoon.
Okay, sounds good. Thank you for putting that together. We appreciate it.
Sure.
We will then move into the discussion on the retirement fund actuarial assumptions and methods and our recommendations that Korn Ferry presented to us at our meeting 2 weeks ago.
Sure. So we all received Korn Ferry's presentation that morning on the updated assumptions and methods and the various options we have. If you recall, I did reshare that, but if you recall the current scenario, it means zero change, and our ADC would be about $1.5 million, a little over. But there are recommendations over the past few years have been to adopt a number of assumptions or methods, including the smoothing method, revised life expectancy, and the revised method for member deductions. If we incorporate all of those changes now, we would be sitting at about 1.7 ADC, and I think because of the performance of the portfolio last year, going into the first quarter of this year, my recommendation would certainly be that this would be a good time to adopt all of those assumptions and methods that they've been recommending over the past few years. And that would include the adjusted rate of return from 7.5 to 7.25% as well.
So I'll kick it off by saying I feel very comfortable going ahead and moving forward with their option 4, which is to accept all of the different changes. It's going to be a drop in our ADC, and we're still at 91% funded, which is still a very strong position. So.
Okay, all right. So we've got the. Any other thoughts on moving forward with these 4 options? 5 options. We could stay currently where we're at, but
correct.
Any thoughts on the other ones?
Well, I just think based on the presentation, this is roughly what they're recommending to all of the other 40 plus Pennsylvania counties that they work with. It seems like a number of other counties this year have already been taking their recommendations. And to Jason's point, even if we approve all of the recommendations, we're still going to have a multi-$100,000 excess compared to budget.
I'd also add that if we don't adopt the changes, I'll say if we do adopt the changes, it's providing us a more realistic expectation of both our risks and our obligations going into the future. So if we don't adopt them now, we end up paying for it in different ways later on. So if it's cost effective for us to adopt them now, I think this is a good opportunity to do so.
Yeah, my only thought is that from a long-term standpoint, how these are going to. So we're looking at this option in a really good year. We budgeted. I think this is our lowest ADC. I didn't bring that chart with me here, but this is our lowest ADC. I want to say in 10 years. Does anybody have that quickly in front of them? I can try to find it. If not, it would be the 2019 Korn Ferry's report from a year ago. But I think this is so. It's looking really nice this year, and we can do it within our budget. My only concern would be if we would if there would be if we would have a negative year, so to speak. We would be I don't know how much it would jump. That's my only thing. I know Korn Ferry needs it relatively soon. That's my only concern. Is this year we have the ability to do it. So I'll just state that there.
Yeah, I can certainly understand. I
Yeah.
was just going to say, to Michael's point from the last meeting when he was explaining it, as I just said a moment ago, we pay for it now or we pay for it later. So, if you don't have accurate, realistic assumptions, then you end up with bad projections and you may end up with surprises down the road with the different assumptions. So we may end up paying more for it regardless of what assumptions we take right now. Whether the ADC jumps up because of bad earnings year or something, but I feel pretty strongly about. I mean, not everything we do, but a lot of what we do, a lot of decisions we make are based on assumptions about what's going to happen in the future, and if our assumptions going forward are more realistic, if the assumptions we adopt are more realistic, hopefully any jump is going to be I don't know, I guess more reflective of the times that we're in at the time rather than the assumptions. Does that make sense what I'm saying?
Oh, it does. No, it's like, and Michael said that during the presentation it's a better reflection of what's happening. Yeah, it certainly is, and that's from the market standpoint, from a individuals living longer standpoint. It just encompasses a lot. It's a great upgrade. They're recommending the IO. We're getting the things flashing on our screen saying you need to upgrade. You need to upgrade. We're like, we like the current version. We like version 1.5. They want us to go to 1.7. So I knew Jason would love that analogy.
Yes.
So
Sorry, I have a visitor.
no, it's okay. So that's the only thing. So
Mike, I will just to your thing earlier, our closest ADC was 2017 at just over $1.8 million. I'm sorry, 2015 was 1.59. But I mean, with our current assumptions, we fluctuated anywhere from that 1.5 in 2015 to almost to a little over 3.1 in 2013. So you're already on our current assumptions, $1.6 million swing between ADCs year over year, just depending on what's happening. To Colleen's point, this just brings it into more realistic, and hopefully we don't see the large swings. We'll certainly have a higher ADC down the road, but this hopefully will eliminate going from 2 years prior $1.6 million higher to 1.5 to a 1.5 million. I'm not saying that's a guarantee by any date, but by any means. But I just wanted to kind of shed that.
Okay, all right. Those were all the comments I had on those. But any other questions or this, and we can look for a motion as well if anybody would want to. We'll give the opportunity for further comments. If there are none, we'll look for a motion. Any other comments on this general discussion before we look for a motion? Okay. Is there a motion? Would somebody like to make it?
I'll make the motion to accept scenario number 4 in Korn Ferry's recommendations of the updated assumptions and methods.
Second.
Okay. It has been moved and seconded to change Center County's ADC to include the revised life expectancy, revised method for member deductions, reduced investment return assumption, and revised assets smoothing method. Any further discussion on this? Okay. Hearing none, all those in favor say aye.
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 Aye. Any opposed say nay. The motion is carried. Okay.
And I'll
All
just
right.
note that's a $482,000 difference.
That's right. Yep. And that sets us up for a conversation about where else we're going to, allocate that money. I think we should probably take a motion then to, to change our payments. Like, how do you want to handle that? Because you were doing a monthly payment of 2.2 divided by 12. It's not earth shattering. We do that now, but maybe our next meeting we can cover that. Why don't we do that? We don't have to
Okay.
sandwich it. You could come back with a recommendation for that, Jason. You're okay with that?
That sounds good. Yep.
Okay, fantastic. All right. So with that business dispensed, we will then go to new business and welcome in our folks from Twin. Looks like we've got Sam, Jeff, Vince, the whole crew. Looking to see if I'm missing anybody else here. I don't think I am. No. So, gentlemen, welcome, and the floor is yours as always.
Morning, everyone. Even this way, it's so nice to see everybody. I was just getting used to the drive up there, and hopefully that'll be happening soon. The COVID shots are circulating, and hopefully, again, everybody that wants one can get one. I know it seemed like it was easier to get, it would have been easier to get Penn State tickets than it would a COVID shot. So hopefully that's all changing, and we'll be able to do it in person. As always, thank you for your trust and confidence in Twin. We appreciate being part of your fund and doing business with you guys and gals. And with me today is Dr. Jeff Garber and Sam Garber. I would like to go off my script for just a minute. Congratulations are in order, and to Twin Capital on April 16th. Twin Capital celebrated their 31st year in business. And as you all know, doing this every day in this environment, that is not an easy accomplishment. So very, very proud of everybody. I am probably the least knowledgeable on everything. And if you've gotten to know me over the years, you know that comes from the heart. So with that said, I'm not going to go on and on and on, and I'll turn it over to Sam for some comments, and then Dr. Garber will take over. But again, nice seeing you all, even in this format.
Thanks,
All
Vince.
yours, Sam.
And to echo Vince's comments about returning to normal, it was nice to be a part of this meeting and have old business. It almost felt like we were in the Willowbank building. So I'll go through a very brief firm update, talk about performance of the portfolio in the first quarter, and then hand it over to Jeff to talk a little bit more and talk about what happened in your portfolio in the quarter, the markets in the first quarter, as well as a little bit of some thoughts going forward. So assuming everybody has the materials in front of them, we'll just refer to the page numbers. We ended the quarter with $1.2 billion in assets under advisement, with AUM, so accounts that we trade versus assets that are using our strategies but using through our model. The AUM contributes to over $1 billion of that number. And so recall that the Dividend Select strategy is holding stocks that have demonstrated consistent dividend payments and growth over time, that also have a smoother stream of earnings growth, as well, and the last point, have a smoother stream of stock prices and volatility. So if we turn to page 8 and look at performance in the quarter, your Dividend Select portfolio for Centre County was up 6.9%, which was nicely ahead of the market's return of 6.17%. Following the past couple years of overall market growth, quite pleased to see this number. Had a strong first quarter. Anytime we can get the market up 6% in a quarter, we'd be probably satisfied with that for a year. Recognizing that that's almost the way there for your annual assumed rate of return of 7.25%. So, pleased to see that in just one quarter. In terms of the portfolio value, it hit a high watermark at the end of the first quarter at $18.4 million. I'll also note, I just looked yesterday that as of yesterday, the portfolio was up over $19 million. Really, it's nice to see those continuing growth numbers as we've had a strong market so far this year in 2021. Before I hand it over to Jeff, as he'll dive deeper into the portfolio and the strategy in the quarter, I'll just mention that we saw a little bit of a shift in the first 2 months of the year relative to March. Where in March we really started to see a turn to investors rewarding higher quality companies, companies that like the dividend select portfolio that have a higher quality nature and also lower volatility. So, without stealing his thunder, I'll turn it over to Jeff.
Yeah, thanks, Sam. And again, as Vince and Sam mentioned, it's great to see everyone, hopefully later this year in person. But just to talk about the portfolio and to review the performance as looking at page 9, if you asked, it was a great quarter. The market's up 6.2. We're up 6.9%. Where did that 70 basis points of value added come from? That value added came from basically from stock selection is the main driver. But I would tell you it also came from the turnaround to value, the turnaround to dividends, particularly higher quality stocks, as Sam mentioned in March. And what happened in March, by the way, and the reason why quality really came back in March is because of a very simple metric that many of you know, interest rates. The 10-year yield on the 10-year bond went at the beginning of the month from 1.44% to 1.74%. It went up 30 basis points. It's a huge move in the month. And all of a sudden, at 1.74%, the market started saying, well, wait a minute here. We're paying a big multiple on all of these high-flying, non-dividend paying growth stocks. Maybe those stocks, we should think about what multiple we're paying if interest rates are now at 1 3/4, maybe a lot closer to 2% than they were at the beginning of the month when they were less than 1.5%. So I think that really, really did help kind of the shift to higher quality, better performing stocks. Now, if you go to page 10, just to kind of talk about the market overall, and we pointed this out in our monthly letter that we send to Colleen and to Jason. We pointed out on April 1st that, believe it or not, in this century, April is the strongest month for the market. You look at the highest average return since 2001, April is best. In fact, for what it's worth, if you go back to 1952, April is second best by 3 basis points at second best. So April's been a phenomenal month for the market. And as we pointed out, if the market hit a high, it ended 2020 at a high, it hit a new high 1 out of every 4 days in the first quarter. 1 out of every 4 days, the S&P hit a new peak. It's obviously continued to hit new peaks here in April. And the market, I would say it's almost a double triple because for those who like basketball, it's a double triple because the average market return for the S&P this century is 88 basis points a month. The average April return through 2020 is 2.68%, so a triple of the average monthly. And this month, the market's up 5%, give or take, and so it's a triple-double. So it's been a heck of a continuation. But the best part about the move in the market, particularly in the first quarter, is the change in leadership, the turnaround to companies that matter. What companies do better when interest rates go up? Well, financial stocks do better because they can take advantage of higher interest rates. So in fact, What were one of the worst performers last year for the first 9 months? Well, it was financials and energies. What were the best performer sectors, as we show you on page 15? What were the best performing sectors? Well, the best performing sectors were, in fact, financials and energy stocks. So there was a real turnaround. Dividends started to matter. Remember, if you look at your portfolio exposures on page 11, just to kind of remind you, so the market was up in the fourth quarter of last year, was up last year overall, but last year was up when many stocks were still down. In fact, we remind you that last year when the market was up 18.4% for the year, 200 of those 500 stocks, or 40% of the stocks, actually declined last year. So last year, yeah, the market was up, but 40% of the stocks still declined. 2 out of every 3 stocks underperformed the market. So you had another 20+% of the stocks in the market that were up, but not up as much as the market. And again, 40% of them, 200 of them declined. This year, the market's going up, and everyone is participating. Everyone is participating. So when you look at your exposures on page 11, the fact that 70% of the S&P 500 is weighted in the largest 100 names, you still have good representation there. 60% of your portfolio is in the largest 100 names. So we're not ignoring those names, far from it, but we're putting an extra 10% weight in those other 400 names that still matter. That still drive the market over the long term, perhaps not in 2020. And so that's really the positioning that helped. On page 12, it's just a reminder that you're buying from companies, not from the overall S&P, you're buying only from the companies that consistently grow their dividends, that are higher quality, that have better long-term dividend growth rates than the market, and have consistent ability to always pay. What's really amazing is to think about these stocks a year ago. A year ago, in March, April, many people were worried about these stocks continuing to pay their dividends. The PPP loans were suggesting companies would have to cut their dividends, suspend them. And while some companies did have to suspend their dividends or lower their dividends, not these companies. We didn't really have the number of companies in the Dividend Select Club stayed around 200, the same roughly 200 number it was last year ago as it is today. So these are really good companies. Obviously, they don't always outperform, but over the long term, they outperform. And I already pointed out page 15 is a really good diagram to show you the reversal. In page 15, the orange bars are through the first 3 quarters of last year. The blue bar is the fourth quarter of last year, and the gray or the silver bar is this year. What were the 2 best sectors this year? In fact, the last 2 quarters, financials and energy, they were in fact the most negative sectors last year through the first 9 months. Whereas tech, consumer discretionary, the best sectors, they're still up, there's still participation, but they're not up and they're not the ones leading the market. So that's really been the turnaround in the story. Page 16 kind of reminds you that the story's just beginning. If you think about defensive stocks, those in red, those are the companies like the Dividend Select Club, like the Dividend Aristocrats, companies that consistently grow their dividends, that have less variability of earnings, less cyclicality of earnings. Those are the companies that on a relative basis have underperformed for a while and are likely now going to outperform for a while. Page 18 kind of reminds you, well, value has started to rebound, but still has a long way to go. Still a long way to go. In fact, on a 3-year basis, growth is still leading handily by double digits. So the comeback in value is just at the beginning turning point. So that's important. And to kind of now, Sam mentioned that we were going to, review your performance, why you outperformed. We talked about the market and then the first quarter, now looking ahead. So page 22, let's look ahead. So we already talked a little bit about the look ahead. We already pointed out that April is a great month for the market. For what it's worth, just as a warning, many of you have heard the sell in May, go away and come back in October. And the whole sell in May relates to the fact that if you look at the average returns for the months of May through September, those 5-month periods, that's the lowest average return for the market, the lowest 5-month average return. So the market usually takes a bit of a breather in the summer. So you should expect that. You should certainly expect it. As Sam pointed out, the market year to date, your portfolio through yesterday, your portfolio is up almost 11%, 10.8, 10.9%, I think, through yesterday. That's a great year. We wish we could close the year, lock that in for you guys, and move on to next year, but unfortunately we can't. So I will tell you that, you should expect that there won't be, that historically this has been a tougher period. The summer's been a more quiet period for the market. The other thing I'd be concerned about today is, and you've heard this, you've heard it probably from your other managers, you've certainly heard it on CNBC, the idea of inflation, right? And why is the media talking about inflation? Well, it's not just the media. If you looked at corporate executives and their announcements of earnings this quarter as compared to just a year ago, there's been, and it's really an unfair number because there was no worries about inflation a year ago, but the talk of inflation from corporate executives today versus a year ago is up 300%. In other words, a year ago, no corporate executives in their earnings announcements were mentioning inflation. Today, most of them are mentioning inflation. Their concerns about it, what they're going to do about it, how they're going to react towards higher inflation. And so page 23 is a really nice chart because it reminds you that we have lived in a non-inflationary environment, in fact, on average, a deflationary environment for much of the last decade plus. Because what this page shows you is every blue bar, that's showing you the 6-month change in inflation. And without going into too much economics, you know that inflation matters, but what matters more is changes in inflation. What matters more is the unexpected inflation than the actual inflation rate itself. Because we can get adjusted to prices going up 3% every year. We could get used to that. The question is, if we go from 3 to 6, that's when it becomes a problem. And so what we're looking at on this bar on page 23 is a 6-month change in inflation. And simply the red lines are kind of showing you, well, yeah, you expect inflation to go up or go down every 6 months. So if inflation goes from 1% to 1.25%, no big deal, right? It's up a little bit. It's no big deal. But if inflation goes from 1% 6 months ago to 1.75% 6 months later, that's a big rise in inflation, even though the rate itself may be lower, but it's a big rise in inflation. Even with that, look at the last 10 years. There's only been one 6-month period in the last 10 plus years where inflation's actually gone up by 75 basis points or more in the 6-month period. Only once. Now, there have been multiple times where your inflation rate has declined by 75 basis points or more in a 6-month period in the last 10 years. A lot of those, but not a lot of rising inflation. You have to go back to really the Great Recession. And then before that, you have to go back into the earlier period of 2000. And before that, then you have to go into the 80s and 90s where you really had inflation or rising inflation. So I do want to remind you that the last two things before we take questions is page 24. So ask yourself, well, okay, so let's look at, this is a 40-year period on this page, 40 years of history plus on this page, on page 23 of inflation. Well, how do various asset classes perform in periods of stable inflation, meaning periods where you're between the two red lines, where your inflation rate changes but within 75 basis points plus or minus? And how does it perform when inflation is up more than 75 basis points or it's an inflationary environment? And how does it perform when you're in a deflationary or inflation is going down by 75 basis points more? And what you see on page 24 is you're looking at page 24, you're looking at bonds on the right, then you're looking at commodities, then you're looking at the overall stock market, and then within the stock market, as you know we like to do, let's take out those high-flying tech stocks that don't pay dividends, so the non-payers of the dividend, the stocks in the S&P that don't pay dividends, and then the members of the club from which we select from your portfolio. And what you see here is that, yes, in periods of falling inflation, the best place to be are those high-tech growth stocks, which has been the best place to be the last 10 years. But in periods of rising inflation, the only asset class, even better than bonds, better than commodities, your best bet are to buy companies like the Dividend Select Club members who can pass on those inflation increases to their customer, right? When prices go up, you still have to buy Tide detergent, you still have to buy laundry detergent, you still have to buy shampoo. But you don't have to necessarily buy those cyclical or luxury items. So they have more impact on inflation, has more impact on them than it does on our types of stocks. So our types of stocks actually, as you could see here, do the best on average in periods of rising inflation. And so that's in terms of inflation, which, to be fair, sitting here today, we're not even yet at 2%, or we're right around 2%. So it's not gone up a lot yet, but we do think it's coming. The other thing we think is coming even in the shorter term are some downward moves in the market. We haven't had any. We've had a real run here. And in fact, page 25 is a reminder of why you have a strategy like a lower volatility dividend select strategy. You have it to protect you on the downside. There have only been 24 days since June 1st. I mean, the market has just run up, as you know, tremendously, 60, 70% in that period. There have only been 24 days where the market's declined by 1% or more. And we're showing you those 24 days here in that first column. And over those 24 days, the market is down almost 40% cumulatively, 39.2% to be exact. Over those same 24 days, your account is only down 33.5%. You've added 5.7%, which is really important. To me, what's more important is the hit ratio, the batting average. 92%, 22 of those 24 days, the market's down 1% or more, your portfolio outperformed. And so I will tell you that the portfolio is doing what it's supposed to do on the downside. The first quarter was a wonderful first quarter. We added very much on the upside. Again, that's because quality became to matter. So in the long term, I would say that, well, in the short term, I would expect to tell you that there will be some choppiness and some give back. I would certainly expect a 10%, maybe 15% correction sometime this year. And I will tell you that your portfolio is well positioned. This portfolio is well positioned for the downturns. And in the longer term, if we are going to have inflation, and obviously the presidential talk last night, if he's probably not going to get what he's asking for, but he's going to get something between what he's asking for and zero, and there's going to be more and more stimulus, and inflation will matter. It won't matter yet, but it will matter whether it's a year from now or 2 years from now. You're going to be seeing a lot more blue dots above that red line in the next 5 to 10 years than we've seen in the last 10 years. And in which case, this portfolio is well positioned to provide a good hedge for you and outperform, as well as protect you on the downside. So with that, we're happy to take questions, and you're nice to. Thank you for listening to our presentation.
Okay, well, thank you, everybody there with Twin. Appreciate it very much. We're happy to have some questions or anything we'd like to ask our Jeff, Sam, Vince. Any questions from the retirement board?
Good presentation. Thank you.
Yeah, it was. Thank you.
Okay.
Steve. Thank you, everyone.
Okay. We're hearing no questions. First quarter is always a quiet one. And so in terms of the questions, we're still seeing how things are going to be developing over the next, over the year. And so, yeah, we'll stay in touch. But any final comments or questions, Jeff, Sam, Vince, before we conclude?
Nope. All good. Thank you.
Okay.
Thank you.
Okay. All right, gentlemen.
Guys, have a great day.
Yeah, thank you very much.
Good luck on the 13th. Certainly, having done that myself, sitting through finals of consultants, it will be a long 3 hours for you. So.
That's
Thank you.
No, we're happy to do it. Thank you. All right, so we would look then for a motion to adjourn the retirement board at 11:37.
Motion to adjourn at 11:37.
Second.
All those in favor say aye.
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 We are adjourned. We are adjourned. Thank you all. Have a great day. Take care.
You too. Thank you.
All right, thanks.
Jeez.
See you.